Something shifted. A quiet change, almost imperceptible to many, has been reshaping a fundamental aspect of American life, our taxes. For years, the conversation felt settled. Then, suddenly, a new urgency emerged. A question now echoes in financial circles, among homeowners, and at kitchen tables across the nation. What happened? Why is everyone, it seems, suddenly talking about the standard versus itemized deduction? It's a debate that now dominates tax season headlines. A choice that determines how much of your hard-earned money stays in your pocket. But the sudden intensity of this discussion? It signals a powerful, unseen force at play. A legislative tremor. A ripple effect still unfolding, years after its initial impact. What caused this reevaluation? And what do you truly need to know about these two paths? First, the basics. What are we actually discussing? Every taxpayer faces a fundamental decision: reduce their taxable income by taking either the standard deduction or itemized deductions. One offers simplicity, a fixed amount. The other promises precision, a tally of specific expenses. Historically, itemizing was a common pursuit. Now? That landscape looks very different. The numbers tell a compelling story. The standard deduction, it's a fixed dollar amount. A base reduction. No receipts required. No complex calculations. The amount varies based on your filing status: single, married, filing jointly, head of household. For many, it's the default. It represents simplicity. A straightforward path. But is that simplicity always the best choice? Or has it become an unexpected trap for some? The answer isn't as clear as it once was. Then, itemized deductions. This path demands detail. It allows taxpayers to list specific, approved expenses. Things like mortgage interest, state and local taxes, charitable contributions, medical costs. Every dollar itemized reduces taxable income. It offers a promise of optimization. Of finding every possible write-off. But the rules have changed. The goalposts moved. This intricate process now holds a different weight. Before 2018, the calculus was different. A significant portion of American households found themselves itemizing. It made financial sense. The thresholds were lower. More expenses qualified. It was often the preferred strategy for homeowners, those with substantial medical bills, or generous charitable donors. Itemizing was a key component of many personal finance plans. A predictable exercise. But the predictable changed. The catalyst for this widespread discussion? A specific legislative act. The Tax Cuts and Jobs Act of 2017. Or TCJA. This wasn't minor tinkering. This was a sweeping overhaul. It fundamentally altered the tax code for individuals. Businesses, too. But for everyday Americans, it primarily reshaped the choice between the standard and itemized deduction. A monumental shift. The full ramifications are still being absorbed. Perhaps the most dramatic change introduced by the TCJA, the standard deduction almost doubled overnight. For a single filer, it jumped from $6,350 in 2017 to $12,000 in 2018. For married couples filing jointly, it soared from $12,700 to $24,000. These figures, adjusted annually for inflation, represent a massive increase. This wasn't a tweak. It was a leap. A financial earthquake, subtly shifting the ground beneath millions. With the standard deduction's dramatic increase, a new default emerged. For millions, their total itemizable expenses no longer surpassed the elevated standard amount. The math simply changed. Suddenly, the complex process of gathering receipts, tracking expenses, and calculating itemized deductions became less beneficial. Why itemize when the standard deduction provides a greater tax break effortlessly? This new reality reshaped behavior. But the TCJA didn't just boost the standard deduction. It also introduced significant limitations for itemizers. One of the most impactful? The state and local tax, or SALT, deduction cap. Previously, taxpayers could deduct an unlimited amount of state and local income, sales, and property taxes. The TCJA imposed a new, strict limit. A ceiling. This was a critical blow to itemizers in high-tax states. A game changer. Who felt the immediate squeeze from the SALT cap? Homeowners in states like California, New York, New Jersey. Urban dwellers with high property taxes. Individuals paying significant state income taxes. Suddenly, a major component of their itemized deductions was capped at $10,000. Many saw their total itemized deductions plummet. Their once advantageous strategy evaporated. A very real consequence. For millions, a financial awakening. Mortgage interest deduction. For generations, a cornerstone of homeownership tax benefits. But even this pillar saw changes. The TCJA capped the deductible mortgage interest for new loans at $750,000 of principal. Previously, it was $1 million. For many, this threshold wasn't an issue. But for those in expensive housing markets or purchasing larger homes? Another piece of the itemization puzzle shifted. Subtle, but significant. Other deductions vanished entirely. Miscellaneous itemized deductions, those subject to the 2% of adjusted gross income limitation, disappeared. This included unreimbursed employee expenses, tax preparation fees, and investment expenses. Small deductions, perhaps, but they added up. For some, their cumulative effect was enough to push them over the itemization threshold. Now, gone. Another reason the itemized path narrowed. What about charitable contributions? These remain an itemized deduction. A powerful incentive for philanthropy. But here's the catch: to claim these deductions, your total itemized deductions, including charitable giving, SALT, and mortgage interest, must still exceed the higher standard deduction. So, while generous donations are deductible, fewer people now benefit from them on their tax forms. A crucial distinction. The incentives reach changed. Medical expense deductions, too, still exist. But with a high threshold. You can only deduct medical expenses exceeding 7.5% of your adjusted gross income. For many, even significant medical bills don't clear this hurdle. This deduction often only becomes truly beneficial in cases of catastrophic illness or very high healthcare costs. A difficult path to leverage. Another factor pushing taxpayers towards the standard route. One of the biggest misconceptions? That itemizing is inherently better or more savvy than taking the standard deduction. This was often true in the past. It's not necessarily true today. The shift in tax law means that for a vast majority of Americans, the standard deduction now provides a larger tax break. Or, at minimum, an equal one with far less effort. The old wisdom no longer applies. A harsh reality for some. The new landscape rewards simplicity. For many, embracing the standard deduction means no more digging through old files for receipts. No more meticulous tracking of every small expense. It means faster tax preparation. Less stress. For the average American, this means reclaiming time and mental energy previously spent on tax minutiae. A tangible, if unquantifiable, benefit. But is this convenience worth potentially missing out? Consider the time cost. The effort. Itemizing requires careful record-keeping throughout the year. Every donation receipt. Every medical bill. Every property tax payment. For individuals whose itemized deductions barely exceed the standard amount, the financial gain might be minimal. Does that small gain justify the significant time and organizational burden? This calculation is crucial. It's not just about dollars and cents. For the average American, the tax journey has fundamentally changed. What was once a routine exploration of itemized deductions has become a quick check. Does my total of mortgage interest, SALT, capped, and charitable contributions exceed this much larger standard deduction? For many, the answer is a swift no. The decision is now simpler. The itemized path, once well-trodden, now sees far less traffic. A new normal. So, who still itemizes? The answer is specific. It's not everyone. It's generally those with substantial mortgage interest on very large loans. It's individuals with exceptionally high, non-reimbursed medical expenses. Or those who make very significant charitable contributions. And in some cases, those with combinations of these factors that push them well beyond the new, higher standard deduction threshold. A smaller club. The dynamic between homeowners and renters has also shifted. Historically, homeownership was a significant driver of itemization, primarily due to mortgage interest and property taxes. With the SALT cap and higher standard deduction, many homeowners now find the standard deduction more advantageous. The tax benefit of homeownership, while still present, has been re-evaluated. Renters, who rarely itemized, remain on the standard path. The critical calculation for every taxpayer: what is your personal itemization threshold? Is the sum of your eligible itemized deductions greater than your applicable standard deduction? This is the fundamental question. If your itemized deductions fall short, choosing the standard deduction is the correct and most beneficial path. It's a simple comparison. But it requires knowing your numbers. And the new, higher numbers. What if you're close? What if your potential itemized deductions are just shy of the standard amount? This is where the strategic thinking begins. It's a point of contention and curiosity. A moment where careful planning could still offer advantages. But the gap to close is now significantly wider than it once was. A challenge for many. A puzzle. It pushes some to consider less common strategies. The new tax landscape means a new normal for tax preparation. For many, it's faster. Simpler. Less documentation. Tax software, for example, now more frequently defaults to the standard deduction, recognizing its widespread advantage. Tax professionals spend less time tallying endless receipts for most clients. The process is streamlined. But awareness of the options remains crucial. The choice is still yours. It raises the question, should I even bother collecting receipts? For many, the answer is no, if they're confident their itemized deductions won't clear the new, higher standard. This simplifies daily financial habits. However, it's vital to stay informed. Your personal situation could change. Major life events, a new home, significant medical issues, substantial charitable giving, could shift the equation. Vigilance remains key. The aggregate effect of these changes is profound. Millions of taxpayers, once meticulously tracking every deductible expense, now confidently opt for the standard deduction. This doesn't mean they're losing out. It means the law changed the optimal path. The IRS reports reflect this massive shift. Fewer itemizers. More standard takers. A quiet revolution in tax filing behavior. The data is clear. The trend undeniable. Families experience these changes differently. For larger families, the increase in the standard deduction might be particularly beneficial, especially if they don't have significant itemizable expenses. The elimination of personal exemptions, also part of the TCJA, was offset by a larger standard deduction and increased child tax credits. So, the overall impact varies. It's a complex interplay. Not one size fits all. For those close to the itemization threshold, a strategy called bunching deductions has gained traction. This involves accelerating deductions, like charitable contributions, into a single tax year to exceed the standard deduction. In alternate years, the taxpayer takes the standard deduction. It's a method for maximizing deductions over a 2-year period. A sophisticated approach. But it requires foresight. This entire discussion, however, carries a time limit. Most of the individual tax provisions within the TCJA, including the higher standard deduction and the SALT cap, are set to sunset or expire at the end of 2025. This means without new legislation, the tax code would revert to its pre-TCJA state. Another potential shift. More uncertainty. The conversation is far from over. What happens next? A looming question. The real stakes in this discussion are your finances. Your hard-earned money. Understanding the standard versus itemized deduction is not just academic. It directly impacts your tax liability. It determines if you pay more or less in taxes. It influences your annual budget. Your financial planning. This isn't abstract. This is concrete. The implications for everyday households are significant. Every dollar counts. So, why the sudden, widespread discussion? Why the lingering questions, years after the law changed? Because the shift wasn't universally understood. Because old habits die hard. Because many still operate under outdated assumptions. The implications are still being fully grasped. For some, it means missing out on potential savings. For others, it means unnecessary complexity. The awareness gap is closing. Slowly. The core reason everyone is suddenly talking about the standard versus itemized deduction is unequivocally the Tax Cuts and Jobs Act of 2017. Its dramatic increase of the standard deduction, coupled with the limitation of key itemized deductions, fundamentally re-engineered the decision-making process for millions of American taxpayers. A legislative act. A nationwide financial consequence. A clear cause and effect. Now, undeniable. What does this mean for you, personally? It means reassess. Don't assume. Calculate your potential itemized deductions. Compare that sum to your applicable standard deduction. For most, the standard deduction will provide the greater benefit, or be close enough that the simplicity outweighs the minimal gain from itemizing. For others, itemizing remains the strategic choice. Your situation. Your numbers. Your decision. Making the choice requires current information. It requires setting aside old beliefs about tax strategies. It's about adapting to the current tax code. Utilize tax software. Consult a tax professional. Do the comparison. The path of least resistance is often the standard deduction. But the path of maximum savings is the one tailored to your specific financial reality. Which path will you choose this tax season? In the complex world of personal finance, knowledge is power. The sudden, widespread discussion about standard versus itemized deductions is a direct reflection of a massive legislative shift. Understanding this shift. Recognizing its impact on your financial picture. This empowers you. It allows you to navigate tax season not with confusion, but with clarity. Your money. Your taxes. Your informed choice. The discussion continues. The numbers evolve. The potential for future changes looms. But for now, the reason for the sudden focus is clear. The way we approach our taxes has been redefined. Stay vigilant. Stay informed. Because what you don't know could indeed be costing you money. Or, conversely, saving you from unnecessary stress. The conversation around deductions? It's here to stay.